Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Tré Bynoe, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Aviso Wealth. For more information or to send in your questions, check out the show notes at trebynoe.ca/podcast. If you want to learn more about me, start with episodes 1 and 2. So let's get into the
No idea.
26th episode. It has been it's been a few weeks. We was on vacation or away with family and stuff last week or the week before.
Yeah, it's all blurring.
Yeah, time's kind of gotten away from us. So it's been a few weeks since we recorded an episode, but we are back.
We are here
vengeance.
now.
There
with
we
a vengeance. Go. Wow. Okay.
Yeah. Fortunately, we record these well in advance, so it's middle of October now, and this will be coming out in middle of November time.
End of November, yeah.
End of November, so
yeah.
We have a little bit of buffer because as I get to my busy season, definitely won't have time to be doing both. So anyway, this episode is this is on investing basics, so it's the basics that I still am yet to go over. And I thought what would be cool is this is the conversation I have with pretty much every new client that I take on, somebody that's new to investing or new to me or anything along those lines, to make sure that the basics are covered. So I kind of get a role play, I guess. We've never had this conversation either.
Yeah,
so
I was
not
thinking
really.
it's not really role playing. I've never done this.
Yeah, so maybe
I'll be the client.
Yeah,
I'm your new client.
So maybe you'll learn. I'll go through literally what the conversation kind of looks like.
Okay.
Yeah. So as I said, it's on investing. So we're just going to start with the basics. Okay, let's just do it. Okay, so I always start with asking them what their experience of investing has been. So, what's your experience of investing been? You can be honest.
Okay, my experience of investing is, here's my money, Trey. Do what you will with it.
Okay, fair enough.
I mean, that's not completely true. Like, I know a little bit. I just have, again, it just doesn't make sense for me to take that on because you're so in that world.
That's okay.
I know. So that I do know a little bit.
So, what do you know? So let's go back to the last big drop that you experienced.
The last big drop was, I think it was when the interest rates all changed for
So 2022.
Yeah.
How did it make you feel?
Mad about the mortgage.
Okay. What about with the investing piece? Because you've seen the investments drop.
Yeah.
Did that concern you? Did that?
No, I feel quite neutral, I think, to the investments.
Yeah.
Yeah.
Okay.
I don't know.
Honestly, that's what a lot of people say. There's very few people that, especially when they're looking in hindsight, do they say, I was really panicked and I lost sleep over it and I was really worried about it. Most people will say something along those lines of, well, especially if they're not retired or anything like that, then I don't know. I know I'm meant to stay invested. So
yeah,
I've always seen it come back, but it doesn't stop people from making bad decisions for some reason. But people tend to know that. So then I'd say, or go down the lines of, okay, so that was your experience. Could you describe what type of investor you think you are?
I think I'm not going to use risk because there's too many definitions of risk.
Well, if that's how you describe it.
I think I'm I want to allocate every dollar for the timeline that dollar needs to be in. You're smiling so big right now. I can't help it. I'm like,
do you think you're a high risk investor, low risk investor, medium risk? What do you think?
It depends what it's for. And what is risk? Like that, those are things that I would genuinely say
That's
because
fair. Yeah,
I can't
that's
help
fair.
the knowledge bias now. I
Yeah.
can't. It's like, that is what I would say.
Okay.
So
So most people will come up when you talk to them about what type of investor they are, they'll
they'll
come
say
up
low
with,
risk.
yeah, they'll say low risk, medium risk. I'm a high risk. She's a higher risk than me. That they'll give themselves they'll assign a risk category to them.
Mm-hmm.
So then my next question is, what does that mean?
Mm-hmm.
Like you say, you're a medium risk investor. Well, what does that mean?
And what do they, or do you want me to just answer? Sorry.
No, I can answer. So
Yeah.
a lot of them, well, the issue is that they don't know,
Yeah.
right?
Because that's what I was
So
thinking. I'm like, what would you say?
yeah, so a lot of people will say something along the lines of, "Oh, well, I've been invested in like medium risk investments, like a balanced fund," right? Is what they'll say. I've been
Mm-hmm.
invested in a balanced fund because I'm a balanced investor. And I say to them, okay, I'm going to go through what risk really means and how we allocate risk in my industry. When we are talking about risk, could you tell me some really risky activities that aren't to do with investing, but maybe to do with money that you can think of is very risky?
Gambling,
Okay,
the
gambling.
lottery,
Okay, okay. Uh, when it comes to investing, what type of investments would you consider high risk?
some random coin somebody made up, like Dogecoin,
Okay, why would you consider a high risk?
because it has no merit. It's just a random thing that society has assigned value to for a certain amount of time.
Okay,
I would
but
say
why is that risky?
because it doesn't actually hold value. Like, I guess the way I would look at it is like a company. Okay, that company has some sort of value. Somebody just saying, I made this money. It's like, okay, maybe I don't fully understand it. That could be part of it too, because I don't. But that's why I would think it's more risky because it doesn't actually, like, what is it? How is it providing any value to anybody? Like, it's just this random thing that somebody made up. Or like, those, I can't remember what they were called, but they were like these digital art.
NFTs.
Yeah, it was, I don't quite, because I don't understand it and I don't really care to understand it all. I just feel like that's a risky investment because I don't have the knowledge personally to understand like what value it actually adds, so I would avoid it.
Okay. When you say risky, why is it risky? So you mentioned a few things because it's somebody just assigning some value to it. So what?
So why is that risky?
Yeah, like you didn't actually say like what's the risk? What are you afraid of?
Like the risk would be losing the money you put in.
Okay. That's the risk that everybody's talking about.
Yeah.
So that's what most people say. So they'll come up with, or I'll help them get to that point where
Yeah.
they'll come up with examples that are risky. Roulette table, risky. Gambling, risky. Investing in a gold mine, risky. And it all comes back to one thing. They do not want to lose money.
Especially, well, I think specifically for me, I don't know, maybe for them too, you don't want to lose what you put in. I don't like that's how I would view it. It's like,
People have an anchoring bias, so it
mm,
doesn't really matter what they put in. As soon as they see a higher number, that's the number that they anchor to.
yeah,
So
that's true. I've done that.
yes, yeah, it's not really about the money that they put in. That is definitely worse, right? If I go put $100,000 into something and it's worth, I still think about a client that I by far the worst time period that they started. Well, they started 2022, so the end of 2021. They put money into the markets and then like it was like December or something, and then just dropped
Oh no.
for a good year and a bit, and then finally came back up, etc., etc. But it meant that their first experience working with me was just losing money. Fortunately, I am very particular about the way I just talk about stuff, so it didn't make a big difference. But even for
Yeah.
me, I'm like, oh, it's just like
Just like
luck of the
starting
draw.
off on the what you don't want to.
Compared to, there's clients that started working with me in the middle of COVID and made a crap ton of money. And I said the same thing to them. It's not me. Timing, luck was on our side, but regardless. Okay,
Yeah.
so most people say risk of losing money. That's really, and I help them get to that point. So, okay,
Yeah.
I'm afraid of the risk of losing money. Okay, and then I say to them, okay, so you said that you have, up until now, you've been invested as a balanced investor.
Mhm.
So I would say the vast majority of people that come and work with me are people that have been investing for a while. I don't really typically work with people that are new to investing.
Yeah.
Normally they have either met a milestone, they've outgrown their current advisor, whatever it is, but they're not brand new.
Yeah.
So I say, okay, so I can see your statements because I'll bring in statements and everything, and they've been invested XYZ. Tell me about that. Tell me how that decision was made.
Like to pick a balanced fund sort of
Yeah.
thing? Like
So I'll say, so you picked a balanced fund here. Why not? So it's a 60-40 fund. 60% of it's in equity, 40% of it's in fixed income. Why not a 70-30? Why not an 80-20? Why not 100% equity? And then we go down the line of, well, most people, they don't really know. It's just what was told to them. They filled out a survey at some place and their risk assigned to them, etc., and they just got thrown in a fund.
Yeah. I feel like it's almost like that 4%, because we just did that episode. It should be just before this one, I believe, where it's like an advisor will just say like 4%. Do you remember?
Oh, yeah.
As the benchmark thing. I feel like it's similar to that. It's almost like the balanced fund. I'm thinking of my pension plan. You just get put in the balanced fund. It's like, oh, why'd you pick that? It's like, I didn't.
It was the default option.
Yeah, I didn't do anything. I just signed the paper.
Oh, given a list of 3 items, this was in the middle.
Yeah.
That's the one
I
I picked.
Sounds great. Yeah.
Yeah, absolutely. Because most people don't understand it. So then I show them this page. And so I show them, so this is, what can you actually see it? Okay, so what you see is along the top, it gives different equity weightings in a portfolio and fixed income weightings in a portfolio.
Yeah.
And I say to them, okay, the data shows for any time frame, the right decision is 100% equity.
That's crazy.
100% equity portfolio is medium risk. Okay, because of what it's invested in. These are broad indexes. I'm a broad market investor. Get into that in a later episode. But what I'm putting you in, this 100% equity, if you did this day in, day out for your whole life, would be most likely the best decision for you. Most people can't live with those ups and downs. I think that's very, very valid. But I don't want to sell you short and use my own bias and to determine what you can or you can't handle. So let's take a look. And then, so what you see is, I say it's a big misconception that something that is 100% equity is suddenly significantly more risky. It's the same equity, you're just holding it in smaller amounts inside of a portfolio.
Okay.
So the difference between that 20-80, so 20% equity, 80% fixed income, and that 80-20, 80% equity, 20% fixed income, there is no difference in the individual items in that portfolio. So it's not different bonds or different stocks.
You're just putting more dollars into
one or the other. And the purpose of fixed income in our type of market is to reduce the ups and downs of a portfolio. And you can see that in action. So if you go to the bottom of this page, you see the red section. What does the 2 labels on the left say?
Lowest 1-year return percent and lowest 3-year annualized return.
Okay, so let's look at the 3-year. 3-year percentages. I try to steer them more towards long-term thinking.
Yeah.
I look at both of them, but for this purpose, we'll look at the 3-year because we're here. Anyway, so the first section, so the 20 to 80, what does it say for the worst 3-year period?
So 20 equity, 80 fixed. And the 3?
Yeah.
It's 0.33 negative. Like negative 0.33.
Okay, and then the next one over, so this is 40% equity.
60% fixed.
Yeah, what's that one?
So that one is negative 2.72.
Okay, and then the next one?
Negative 6.29.
Okay, next one?
The next one is 80% equity, 20% fixed income, negative 9.75.
Next one?
100% equity is negative 13.01.
Okay, so what that shows is there is a direct relationship to the amount of equity you have in your portfolio to the downs that you would likely experience.
Mm-hmm.
Okay.
Yeah.
So that is important to know. The more equity you choose to have in your portfolio, the more downs you are going to experience. There is no two ways about that. You will experience more downs the more equity you have in your portfolio, or at least you should expect to.
Yeah.
Right?
Yeah.
Above that is so not the standard deviation, the one above that. It's the annualized returns. See that?
Oh, yes. This
Okay.
section?
I can't see.
Oh, sorry. I'm holding the
Annualized
laptop
returns.
looking at the screen myself and I'm like, this one? Anyways. So the top one or
Yeah.
okay. And you want me to go through every number or
Yeah. So but just highlight it. So this is the 80-20 one. What is the number?
5.72.
Okay, then the 60-40. Let's just use them.
Jump up is 8.07.
Okay, keep going.
And then 80% equity, 20% fixed income is 9.07, and 100% equity is 9.96.
Okay, so what you'll see there again, what's the relationship?
The number stayed pretty similar. Sorry, I wasn't really paying much attention.
You're not paying attention. How is anybody listening?
I'm sorry. No, I just mean like I'm looking at this chart and I don't fully understand it. I'm trying to focus on the numbers, but
So what? Sorry, what don't you understand about this?
like what am I looking at right now? Standard deviation or whatever?
No, I said don't look at that one.
Yeah, I highlighted the ones I was looking at.
Okay, that's not standard deviation. So this is return. So this is the return of these various portfolios over different time periods. So this is between 1994 and 2024.
Okay.
But above here, you'll also see 3 years, 5 years, 10 years, 15 years, 20 years. But what you'll notice amongst all these years, no matter the time frame that you pick, you'll notice the more equity you hold in a portfolio, the higher the return.
Mm-hmm.
There's a direct correlation between the downs you'll experience and the return you'll get at the end of the day.
From equity.
From equity. It doesn't mean that the portfolio is what you're holding is significantly more risky. Of that risk that people are scared of, the risk of losing all of their money. So, but it does mean that you will experience higher ups and downs.
That's like what we talked about in the risk episode, where it's the market risk, which is the risk of the markets moving.
Mm-hmm.
That's that risk.
Yeah.
But people just assume that's like the absolute risk, right?
Yeah.
Sorry.
Yeah. So, okay, so I go through this with them and I say, I will want to push you towards as much equity as possible because I would rather you turn around in 20 years and say, I have to talk you off a ledge of investing. I think I can do that pretty well. Versus you look back and say, hey, I could have handled 100% equity. Not that I recommend 100% equity to everybody, but I could have handled a lot higher equity allocation than I did. And now I am hundreds of thousands of dollars worse off because I said, I don't think you can handle it.
Yeah.
Right?
Yeah.
And the reason is because with more education, people's risk tolerance goes up when it comes to investing.
Absolutely. Yeah.
So a lot of it is to do with not understanding, not knowing, not caring to know, versus truly risk that you're facing. Okay. So that's what I go through with them. I say, so what I like to do is match the time frame to when you need the money. Because while I don't want to tell you, I don't want to not give you enough risk, not increase the allocation to equity. Sorry, let me rephrase that. I do not want to undersell you on risk, the amount of risk that you should take in a portfolio. I also want you to be able to stay invested while you're learning.
Yeah.
And a big thing for me is I like to teach and I want you to learn how to make these decisions yourself. So I use a framework. What we'll do is we will determine how many years of safety you need.
Okay.
And that safety, however many years we decide, that safety will be our cash and our bond allocation.
Right.
And that is how we'll build the portfolio.
Yeah.
So it means that when we are investing especially in a non-registered account or like money you can access, the first thing we'll do is we'll build up, and every penny that we're investing will go towards building up those years of safety. And then everything that we're investing after that will be into equity.
Right.
And what that would mean is your safety allocation in your portfolio will stay very, very stable, very similar. And then we will revisit the overall allocation as time goes on.
Because those years of safety might change and whatever.
Yeah, but those years of safety are there. And that
Yeah.
then allows us, me with my knowledge, I know, okay, we have XY amount of years. That means we can take the risk, the ups and downs, the market risk with the long-term money. Okay. And that's where I get investing to the right time frame for, because that's how you push somebody to invest to the right time frame.
Yeah.
Okay.
That makes sense. Give us a little safety blanket, you know.
Yeah.
But at the same time, yeah, making sure people learn. Man, you sound like a great advisor. I think I'll hire you.
Okay. So then I talk about how we invest. So a lot of Canadians love Canada. They love to invest in Canada. If you give them half a chance, they'll invest everything in Canada. All Canadians hate the US right now. So nobody wants to invest in the US. This has been a theme for a very, very long time. So then we move on to this chart here. This chart shows the global equity markets capitalization. The big gray box, you see that? Can you kind of describe how big that box is?
On the
your
page.
screen?
Yeah, the big gray box is like a quarter of the screen, I would say.
Okay.
A third of the screen, maybe.
Okay. And what is that? That's the US market. You see that little box above?
Like within it?
No,
Or this
above.
one?
Yeah. What does that say?
Canada.
Okay. So the US it gives a percentage there.
Yeah, so, okay, it shows the big gray box is the US, 65%.
So 65% of the global equity markets is the US.
Okay, and then 3% Canada.
Yes.
Wow, what are we
Look
doing?
at Apple, which is
Apple is 4%.
Exactly. So when people say, "Hey, I just want to invest. I want to exclude the US." No, you don't.
Yeah.
You don't want to exclude the US. No matter if you hate the politics or whatever it is, do not let that get in the way of you making good decisions with how you manage your money. And the reason that I also will show this is because this is the reason we invest internationally. So right now in 2025, international investing is the craze. I've been investing internationally forever.
Yeah.
It's how you invest. It's not a fad to now suddenly start investing internationally. Internationally is a huge part of the world's markets. You should invest there. You should have money there. You shouldn't just do it because you're not so thrilled with the US. Okay?
Yeah.
Globally diversified in a logic-based manner, rules-based manner will get you good results. So this is why I say, and they'll often come in with these ideas. Oh, I don't want to invest here. I don't want to invest there. There are advisors out there that will cater to individuals' preferences in that capacity. I am not one of them.
Yeah.
It's as simple as that. When I am investing money, I need to know it's going to work, or as much certainty that it's going to work as humanly possible.
Yeah.
Right.
Without knowing any of the future.
Yeah.
Do you think it's just because people are like, oh, I live here, so I'm familiar with it, and that's why
There
I
was
want
also
it?
rules. There used to be rules about you had to invest a certain amount in Canada.
Oh.
And you should absolutely invest in Canada. I think I think Canada is actually a very, very good place to invest.
Yeah.
It's just not the only. It shouldn't be 80, 90,
Yeah.
95% of your portfolio. So I limit it to around 30% of a portfolio. That's where when you look at the numbers and the data around in that range between 25 and 35 is a sweet spot for home equity. So that's where I keep it.
This is kind of like a quick story or theory, I guess. It makes me laugh to think back when I was a teller, people would come in maybe I don't want to stereotype. I'll just say some people would come in and say, oh, I don't want to keep all my eggs in one basket. So they'd have multiple checking accounts at different banks. And I always thought that was so weird, but I feel like those are the same people who are only invested in Canada. Which is I think you have the whole idea wrong. Anyways, I digress. That's just a random little thought that came into my head. Not to offend anybody. Hopefully.
Yeah, well, I'm not getting into that.
Yeah.
Okay, so talk about global equity market capitalization because I want people to understand how big the world is. Okay. Then I focus so heavily on the downs that you'll experience. We saw the upside of the markets. Everybody knows the markets go up. It's been the single best wealth building tool humanity's ever created.
Like the markets?
The markets.
Yeah.
Global financial markets, by far, bar none. There was a time when if you was in ancient Rome, in order to be able to grow money, you had to then go and start a business, buy land, etc. You couldn't, the average folk couldn't just go in and buy a small piece of the Roman economy.
Yeah.
You couldn't do it. It meant having the global markets is a significant equalizer when it comes to wealth creation because everybody's got access, right? In our part of the world.
Yeah.
Very clear. Okay. Anyway, so this is the S&P 500, and these are intra-year declines. So we look at the markets and we say, okay, it goes up. People know that it goes up. Year to date, so in 2025, when this was, this is as of the last quarter. I haven't done my quarterly review yet, sent it out, but I guess by the time this goes out, it will have been out for a month. Anyway, so we see here in gray, so the gray bars are how the markets performed in that year. Okay, at the end of the year, so January 1st to December 31st. So
but this is a quarter of it? Sorry.
No, this is just this year to date one. So but all these previous ones are years. Okay, so it goes all the way back to the 80s.
I see 2008.
Yeah.
Okay, what's that big line going down?
Okay, but what is the red? The red dots. What do you think that is?
The red dots versus like the line.
Yeah, so the black lines are what the year ended at.
Yep.
What do you think the red is?
Probably the lowest low of the year.
So the biggest drop during the year.
Yeah.
What do you notice?
It's always the black line is always higher, it seems.
True, it is.
Just off of a quick glance.
Yeah. It is. But there is one for every single year.
There is a big drop, yeah.
The markets never just go straight up during a year. Not how the markets work. Even in great years, so we look to even the most recent times. So last year, so 2024, there was an 8% drop and the markets were just on a tear. 10% drop the year before that, 25% drop in the year before that, 5%, 34%. The 34% drop was COVID and the markets ended up 27%. Right?
Crazy. So that's like a really big swing, I guess, when you think about it.
And even in down years, so that this year, the biggest drop was negative 20%. So I have $1 million invested, dropped to $800,000 and ended at negative 6%. Right? And then it was followed by great years, etc. But you'll notice that every single year there were big drops.
Yeah. Or a drop of something.
Depending on what you consider a drop. Big drops. The average drop is 14%. But the returns were positive in 34 out of the last 45 years.
Wow.
So the batting average, 75% or so, the markets are up. It's even with these big drops.
Yeah.
But you have to expect the drops.
Yeah.
And I focus heavily on there because, well, first of all, I don't want to answer hundreds of people's calls every small drop.
I want to pull it all out.
Yeah, every 5% movement. It's like 5% movement happens in a week. I sleep fine.
Yeah.
But I need them and people to understand that market swings are totally normal.
Yeah.
In fact, I am more concerned when there's not, because then it means something else is going on.
Yeah.
So even this in the last year when only negative 8% it was straight up practically the full year. So it's just to keep in mind when you're investing, big drops are normal, totally normal. And that's why I struggle with advisors that just put clients in low risk things out of the gate, because why is this scary? This is only scary if you
are investing for 3 months and kind of thing.
And even though I would say it's only scary if you don't understand it.
Yeah.
If you don't expect it, if you think that, markets don't do this because you've just looked at the gray lines and you're like, okay, well, one in every 3-4 years is a negative year. And then suddenly you're in September and markets are down 15% and you're thinking, well, this only happens once every 3 years. It's like, no, this happens every year, multiple times a year. This is normal.
Yeah.
Don't worry about it. Not the point.
Go
Just
about your
be
day.
fine with it. Yeah. So make sure you have a plan. And that's when I start stressing, make sure the way that we'll invest is we make sure that you have a plan. If the markets drop tomorrow, what am I going to do? And unless you can answer that, I don't even know. You need to be able to answer that.
Over? You're like, okay, back to
you
square
need to
one.
no, just for people in general, if you're investing and you can't answer that question, you are probably taking on too much risk. Taking on too much market risk. That is a really important question to be able to answer.
If someone was like, asked me, okay, if the markets go down tomorrow, what are you going to do? I would just be like, nothing. Is that a valid answer?
Right? But why can you say nothing? Well, I've got employment. I've got a job. I've got,
Yeah.
I've as long as you have a plan. So people that are relying on their money, for instance, that's where we get the cash wedge, which will be in a later episode. But we have a plan. You need a plan.
Like people who are retired already. Who
Well, not
take
not necessarily retired, just relying on their money. Think of it as you're either, because lots of people I work with lots of people that will work part-time, right? Because they have enough to make ends meet or whatever. So just as long as, if there's money that you're relying on, you need to better answer the question, what am I going to do if markets drop? And for me, for instance, because we're 100% equity, don't keep very much cash, I have lines of credit for that scenario.
Yeah.
Right? And people, whatever your opinion is on that is irrelevant. I have a plan.
Yeah.
If we absolutely need to, I can borrow money. I have access to capital if we needed to. There's also something to be said to, even if markets did drop, let's say they dropped 40%, it's still worth more than I put in. It gets to a point when...
But it's not that anchor, Tré.
It's not that anchor.
I like that anchor.
Yeah.
The biggest number. That's my new
That's your new starting point. Yeah. Yeah.
Not the lowest, the biggest.
Yeah, of course. Yeah. And you reset it every year as soon as it hits the
Yeah.
Yeah. And statement months, the worst months, because if it happens to be a high and then a low, it's the worst thing. But if you get the high and then the market crashes and it recovers by the next statement, like it did this year, nobody even knows. It's like the anchoring bias is, it's huge. But anyway, so they're the things. They're the 3 points that I hit pretty much in every single when we're talking about the investing piece. And this doesn't typically come until either very close to the end of the appointment, because that's when I'll go through exactly if it's like a newer client, exactly how we're investing. If it's a client that I need to do planning and stuff like that for, then we won't even talk about actually what it's going to go into. I'll just give them an idea of what I'll be using to construct their portfolio. But this is what we're going. And the only other thing that I discuss, and this is dependent on the individual and where they are in their life, is portfolio funds. So portfolio funds are a really easy way to invest for a host of reasons. I personally hate them. I understand why you'd want to use it. I really do. And for the vast majority of people, if you are just putting money aside for retirement and that is what you're investing for, I think they're great for that purpose. But as soon as you are accessing, like, there's stages of wealth creation. One of the stages is using your portfolio to pay for your life now. As soon as you're in that scenario, you need access to different areas of your investments. As we first looked through, the first thing that I showed you with how they've performed and showing that fixed income's job is a stabilizer for the portfolio to reduce the downs that it experiences. That's all in your head, I guess. Like, visually, it reduces the downs. But if you can't actually access it during those downs, what good is it?
Yeah, it's just like a mental thing then.
Yeah, it is. And a lot of people, advisors, even some that I kind of respect, have made the mentions that, well, you'd be rebalancing at that point anyway. Like, it would be a good idea to, if you're a 60-40 investor, you should always be a 60-40 investor, right? Through the ups and the downs. Unfortunately, I completely disagree. I think that people will and should change their approach as life happens. So, for instance, if we have a 60-40%, a 60-40 portfolio, and we're in 2008, and that means that the 60 part of your portfolio, the equity piece, the growth piece, has halved in value, I think you should be either selling to rebalance, which to his point, to that advisor's point, that would happen automatically in a portfolio fund. So you wouldn't have to make the decision. So that is the upside. But if you need to access funds, then I would want to rebalance and take it out of my fixed income. And that means that maybe now I'm an 80-20 investor or whatever. And my goal is, okay, I'm going to revisit this once this crisis has happened or whatever.
Like recovered,
yeah. But I really want to be able to access the part of my portfolio that is the safety net.
Yeah.
And that's why investors, like actual investors, hold cash, and they hold, like, you think of Warren Buffett, he holds cash.
Huh?
It's like, exactly, there's too many layers in a portfolio, because a portfolio fund has a bunch of things in there.
Okay.
Ton of things in there, just one item, you just set it and forget it, and it rebalances itself. You have a manager do it, but you don't actually have the ability to reach in and take something out of that, or
like a
spend
specific
something.
thing.
Yeah.
Like
the way I describe it, I have a picture of a spice rack in my office, and I say, if I needed a barbecue spice mix, the easiest thing for me to do is to buy a barbecue spice mix. That means every time I want barbecue spice mix, I have one container, I go and I use that container, I put it back in the shelf, who cares? But as soon as I want a different type of spice mix, then I have an issue if all I have is barbecue spice mixes.
Or if someone's allergic to one of the spices.
Okay, you're going, that's not, let me finish my illustration before you try to complicate it. So it might be harder for me to have all my spices individually, because it means then if I need a barbecue spice mix, I now have to mix my spice mix. That means that it's more work. It's more work for me as the advisor managing the money to do that. But it means that if the client then decides that I don't want a spice mix, or somebody's allergic to a spice in that mix and I'm having company over, I can exclude that. I can access individual parts of that spice rack. It's more work. It's more annoying to do. But when you get to a certain level of wealth, where you want options and you want somebody that will rebalance appropriately, do it without the emotional side of things, but if need be, you can access the cumin, you can access the paprika separately from everything else and leave everything else alone, because the markets are going crazy and the US equity is down and the international is down, but Canada is doing very well. Well, maybe I want to leave everything else to recover and just spend from Canada, right? Yeah. And while I get the simplicity side of it, when you get to a certain level of wealth, you want options, and you want to know that whatever happens in the world, you'll be okay. And that doesn't come from single ticket portfolio funds.
Like a cut and paste kind of, yeah.
And
that's a really good illustration.
I know the allure of it. I get it. And it is more annoying to do it the other way. It's more annoying for me. I wish I could unthink like that, because man, my life would be easier when it comes to portfolio construction and everything like that, because I could just put in it. But it's just I can't with good conscience do that. It's just, you need options. I would never do that for myself. So you need options.
It's not like customizable at that point, almost. Hey,
no, it's not. And part of it is when I don't customize to that degree with clients either. For me, it's about risk management and being able and having the ability to manage risk appropriately, no matter what happens in the world, no matter what happens with that individual. Like I never want to be in a situation where my decision, the way I invested, led to somebody not being able to do something where I could have avoided it by doing the extra work. So anyway,
you're definitely not that type of person.
No, no. But anyway, that's basically the investment spiel I have with clients as they come in. So maybe now I just send them to this podcast and I'll be like, all right, go listen to that. And when we get together, you'll already know. You'll be like,
that
I
was actually really good. I really liked how you, like, the way you questioned things. I guess I could see as if somebody didn't have any background, like how that would help them learn, sort of thing. So yeah, it was really good.
Oh, thank you.
Welcome. I have no bias at all.
No.
Again.
No. But the questioning start is, I mean, it's just like you get better as you go on. And because I now have a goal, you're not the only person that said that. Like it is different when even like the risk tolerance questionnaire and stuff, which we should actually go through at some point as well. Maybe I'll put that on the list. It's different than a lot of other places will use because I'm measuring something different, right? I tell clients that I want to try to invest to their capacity for risk, like how much risk they should be taking from my professional opinion, and then try to coach them to that level versus just invest according to wherever they are right now, which is subject to knowledge and understanding.
So many things. Even like the market, again, because my industry was marketing, all the things you're saying, I'm relating it to that. What's happening in the world directly impacts the markets. Well, like the markets are in business and stuff. You know what I mean? It's like, it's all connected. So
it's all connected.
I know. I'm like, my intuition is like, I'm not even making sense. Probably it makes sense in my head. I just struggle to
just
articulate.
To nobody else.
Yeah, pretty much. Struggle of my life.
Perfect. Okay, next episode is a case study. So which will be actually really interesting to go through. So I have a pretty detailed case study because it's based on somebody. So we're going to kind of go through it. I'm going to change a bunch of stuff in there, obviously for privacy reasons, but we're going to go through it and discuss goals. So a lot of people will hit financial goals that they'll have, and they struggle to either come up with new ones or realize what they should be doing after that. So this is a couple that has kids. They have reached something I like to call velocity. So where retirement velocity, where if they stopped investing, for retirement, they would still, the markets on their own would meet their retirement goals, their base retirement goals. So that's a big milestone to reach. A question is, okay, what milestone should we be reaching after that? What should we be looking to do, to accomplish, looking at it from a financial planner's point of view? So that'd be the next episode. Okay. Perfect. We'll see you guys in the next one.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bynoe, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.